Okay, everybody, so she'll make sure I'm plugged in the right spot. We're moving on to Chapter 4, Consolidation Techniques. Now, what we had last week is kind of the baby steps of consolidation. I think you guys are going to do a really good job this week. Once you've gone through, it's really important that you follow the step and try to go through and work that Chapter 3 as much as possible, and then we move on to Chapter 4. Okay? So let's go ahead and take a look at what we're looking to do with this particular chapter. First thing we're going to do is prepare a consolidation work paper when the parent uses the complete equity method to account for its investment in a sub. And then remember the equity method being when the parent is owns a certain percentage of the subsidiary. Now, last week we were doing like 80% or more. We're going to be looking at different amounts, or I'm sorry, last chapter, not last week. All right, we're going to prepare a consolidation work paper for the years subsequent to the acquisition. So we're going to start looking at subsequent years. We're going to find errors in the paper, record the fair values of identifiable net assets, prepare a statement of cash flows, very fun. I don't think we're going to have enough time to do the electronic worksheet spreadsheet. You will have enough spreadsheets. You know me, I love a spreadsheet. And then I'm not sure if we're going to be able to squeeze in the appendix. We'll see how it goes. Okay. So let's look at the acquisition year work paper. So the things that we're going to need to prepare the worksheet are going to be the income statement, the statement of retained earnings, and the balance sheet. So we're going to use all these items, and then we're going to use them both for parent and subsidiary. So we're going to have the parent stuff. Remember, that comes in, we kind of leave it alone other than its investment in the sub. All the subsidiary is where we're going to be adding and making the adjustments. And then debits and credits for consolidation entries, and then a final column for everything consolidated. Okay, so as we complete the worksheet, each parent and sub starts out at 100% of book value, even if the parent owns less than the sub. Okay, so if the parent owns less, we still want to make sure we get that book value at 100%, and then we can make the percentage adjustments later. We're going to enter the elimination entries into the debit and credit columns, checking totals. For consolidated revenues, liabilities, and equities, other than ending retained earnings, we're going to add the parent subsidiary less the debits and credits, and then for consolidated assets, we're going to add the subsidiary less the debits and credits, and these are all for the adjustments in value. Okay, and then for income, ending retained earnings, and all subtotals, we're going to compute those directly into the consolidated column. So those things are going to be in that very last column. The total consolidated assets should equal the consolidated liabilities and equity. Expenses on the income statement and dividends on the statement of retained earnings are generally shown as negative numbers. So just get that on your mind, and then you'll compute the consolidated amounts as you would for revenue. So that, I'm just kind of reading from the sheet, but just to kind of reinforce. The work paper entries, we're going to eliminate. After we adjust for errors and omission, we're going to eliminate those intercompany profits and losses, the income and subsidiary dividends. So we're going to bring the investment account to its beginning balance. We're going to record the non-controlling interest in the sub's earnings and dividends and eliminate the reciprocal investment. And then we're going to amortize the fair value differentials, which we did last chapter. You guys are awesome at that. And then we're going to eliminate reciprocal balances. Okay, so our good old friends Pop and Son. Pop paid $176 for 80% of Son on 1/1/16 when Son's equity consisted of $120 for capital stock and $60 for retained earnings. All the excess was due to some unrecorded patents that had a 10-year life. So this is just giving us the problem. And here is Son's income and dividends for 2016 and for 2017. Okay, so let's look at Pop and Son. I actually brought in the example slide from previous just so you could see kind of where everything goes. The first thing is we purchased 80% of Sun for 176. So the implied value is to divide the 176 by the 80. Hopefully this is super old hat and you know that the implied value is the total value of the company of Sun. Remember, we're only buying 80%, but we need to know that total value of the company. Why? So we can kind of suss out the non-controlling interest amount. All right, the book value is the value of the, and I'm going through this a little quicker because at this point, this should feel like old hat, is the value of the capital stock and the retained earnings right here. Added together, book value, boom, and boom. Okay, and then the excess over these things, 40. Okay, everybody feeling pretty strong about that? That's going to go in my unamortized balance of patents. As the problem stated, remember, excess was due to unrecorded patents. I'll try not to mark through that, with a 10-year life. So we have a 10-year life, so we're going to divide those patents by 10 years. Gotcha. $4. Okay, got it. There you go. The unamortized balance, 40 minus 4 equals 36. Right here. The amortization each year in 2017, the very next year, is $4. Remember, $4 each year. So now we know our unamortized balance on the very last day of the year. Okay, so what we're coming up on right now is the most important slide that we're going to do in this entire presentation. And that is how we break out the differences between the dividends and income, between POP and the non-controlling interest. So remember that in previous classes, previous lecture in chapter 3, we didn't have to worry about this. We were doing 100%, okay? No problem. But now what we're going to have to do, as they're presenting the dividend and income from the POP perspective, POP is presenting it at 100%, but we have to suss out our 80% share and kind of scoot the non-controlling interest over to a special section in the balance sheet and take that off of what we would earn. So when dividends are presented, we can only show our share in the consolidation. So let's take a look at this. So first we have Sun's net income of 50 and the amortization of 4 from previous slides. So our adjusted income from that is 46, all right? So for the 46, we have both the 80% share of POP and the 20% share of non-controlling interest. So I'm going to try to kind of circle. Oh, let's just get that eraser out here. Try and highlight this. Let's try and highlight this. Might be the better move. So this right here, right here, right here, 46. All right. And then here's the non-controlling interest share. And what I'm doing in my calculator is taking the, see if I can find it really quick here, 46 times 0.8. This is it, 46 times, see if you can see that, 46 times 0.8. Try and do it backwards, right? Times 0.8. All right, and that's where, I'm trying to show this, 36.8 is coming from. I'll do it the same way. I can either take out the 46 and subtract 36.8. That's the next thing I'm going to do. Or I can multiply 46 right here times 0.2. And that's where my 9.2 comes from. So right here is my adjusted income, right here, for this part. Again, super duper important slide. Now let's take a look at the dividends. let's take a look at the dividends. All right, let's get this one going. Again, Sun is presenting all of their dividends, and we have to suss out what belongs to us on the pop side. So what we're going to do is multiply that 30 times 0.8 and times 0.2 to show the non-controlling interest share. Okay, so that's how we get that part right there. Now let's look at 2017. Brand new year, new year, new you, or new pop, new Sun. So let's look at 2017. Adjusted income in 2017, same situation. We're going to come out here, take the 56, all right, and that's going to be Pop's 80% share, all right. 20% of the 56, where the difference is going to be the non-controlling interest. Let's take a look at the dividends. You have to make this sheet that, oops, did not mean to make it that sloppy. Let's try this one here. You want to take this sheet, get it fixed up, and then just kind of set it aside because it's just going to kind of keep coming back and be needing to use. 80% of pop right here, non-controlling interest, 20% share. And there you are, you're all set. You can see where everything kind of flows through. Most important workout of the entire lecture. Hang on to the sheet. I'm going to be bringing it back throughout the rest of the lecture. Okay, so good news, we don't have any errors, no omissions. And again, if you're going back to that checklist I was kind of reading out loud, that was one of the things we had to do. Good news, this time we don't have intercompany profits and losses. Yay, no work there. But we do have to enter and eliminate income and dividends from the sub and bring the investment account up to its beginning balance. Can't avoid that one. So what we're going to do is we're going to take the income from Sun, and from this, what we're going to use is our share right here. Our 80% share is what we are concerned about when we're doing this. All right, so that's going to be the beginning of our journal entry right here. And again, we've got them all figured out. If you do this figure first and then just kind of carry it around with you, you'll have it for all of these entries. And again, I'm using the 36. The second thing I'm going to do is I'm going to go ahead, remember dividends has a debit balance, I'm going to go ahead and credit the dividends. And again, I'm in 2016, not 17, but I'll go ahead and bring this down here. It gets a little confusing. Make sure you get your correct date. Now, someone asked me, where does this 12.8 come from? Plug. This is a plug. P-L-U-G. I've got my dividends and I've got my income, and I just plug my investment in Sun. Okay, so the next thing I need to do is work on the worksheet entries, okay? So let's go ahead and record the non-controlling interests in the subs, earnings, and dividends. So remember, we were looking at ours. Now we're going to look at the non-controlling interests information in this particular situation. So the non-controlling interest, if we walk over here, and again, I told you it was the most important sheet we deal with, right here, we're still in 2016, 9.2. I know you can barely see. I tried to bring it over so you could see it. Here we go, right here. The dividends, again, barely see it. It's kind of small. I'm really sorry. I'm trying to make it so you can see it. 6.0. Now, weirdly, they had the same amount of dividends. I mean, not weirdly. They probably just shot the same amount each year. But it just happens to be the same amount for each year. Don't get confused and grab from the wrong year. And then again, non-controlling interest, 3.2. P-L-U. Trying to make a U with my mouse. G. P-L. This is a plug right here, plug. That is the word plug, okay? Now we're going to eliminate the capital stock in the subs equity balances. And what I can do here is I can direct you to go back to that beginning problem sheet. So walk back a few slides and you'll see our beginning retained earnings, patents, and capital stock, all right? And then our investment, again, in Sun was for 176. That's all on that first page. I didn't have enough room to bring it in from the slide. But if you walk back 3 slides or put these slides side by side, and hopefully you get this from that, and then plug here the non-controlling interest. I'm getting better at writing the word plug with 2 fingers on my mouse pad. Okay, so this is just all information we got early on. And then of course our investment, what we paid for, and then our plug. Okay, so here now we're going to go ahead and amortize the fair value book differentials. And you may not remember this. This is slide number 9, where we figured out the difference between the two, book value and fair value, was a patent. And the patent was amortized over 10 years. And here again, just to remind you, so we're just going to make a debit to amortization expense and credit to patents. And that'll go right up against the account. There's no accumulated depreciation. One other thing they said, here last chapter we were doing all those entries on the balance sheet. This chapter we're doing them on the balance sheet, or the worksheet. It's going to be the income, the statement of retained earnings, and the balance sheet. So we're adding a little more spice this chapter, so to speak. Okay, so moving along now, we're going to look at the consolidation worksheet. Again, we're on 2016. So what we're going to do is go ahead, we're going to add, again, should feel like old hat, revenues. Income from some is going to get wiped out. I'm doing this a little quicker now. Expenses, these expenses are known. This one right here represents that amortization expense that we had to add on earlier. The non-controlling interest share, again, I'm just going to kind of wipe out 2017 so we don't accidentally grab it up. The non-controlling, I don't know if you can see this right here, but the non-controlling interest share comes from this calculation, right? The non-controlling interest share of the we're going to go ahead and take out the non-controlling interest share of the adjusted income. All right, and then the next thing we're going to do is we're going to look at the retained earnings. Again, we're wiping out Sun, adding net income from some, which was in the problem, deducting dividends, which we had again for POP right over here. Okay, and then somebody say, well, what is this part that says, just trying to see my own stuff. What is this part? This is blank. This right here, this 6th amount. This is the share of the dividends from the non-controlling interest right here. That's the non-controlling interest dividends. Okay? So a lot of be kind of pointing, but just go through, follow it through slowly. You may have to watch this one twice just to get it all in your mind as to where everything goes. Okay, so as you'll notice, I brought in a few past slides. I tried to minimize them so I could kind of give you a run through of how they fit on the balance sheet. So the first thing we're going to do is we're going to work on this consolidation. The first thing, let's do the easy part first, which is the cash. Simply combining the cash of POP and Sun for the total consolidation of the balance sheet. All right. Easy consolidation of the other current assets. These come together nicely. All right. Nice and easy. Okay, so the next part is this investment in Sun. And I want to tell you what this comprises. It comprises 2 things. If you walk back to the problem, way back at the beginning, they bought Sun for 176. And here I'm pulling it out in this reciprocal investment journal entry. Unfortunately, I wasn't able to squeeze that slide on there, but this is what they bought Sun for, okay? Right here. Now, where does that 12.8 come from? So let's look at that really quick. if you remember when we had our adjusted income of 46, way back at 2016, that's Sun's net income for the total year. Now, if Pop owned 100%, Pop would own all of the adjusted income, but Pop does not own 100%, so we have to break it. Remember, we had to break that income down between Pop's share and the non-controlling share. And the non-controlling share, or we had to break it down between Pop and the non-controlling share. So the Pop share of that was the 36.8. Remember that income from Sun? So that comes in right here, right? And then the next thing we had to do was credit for the dividends, which were 30, right? And again, we broke it down between Pop, which was 24, and the non-controlling interest share. So Pop's income, credit the dividends, and then I said, I believe I wrote in there that this was a plug, right? For investment in Sun. Well, this plug comes back to play right here. This comprises the entire investment in Sun. The difference between the income and the dividends is the actual investment in Sun. So we're going to add these two together, the 12.8, and you can see here's a little bracket. Add these two together, and that's where our 188 comes from. Basically, the difference between income and dividends is investment. That's basically where that comes in. Okay, so now let's go to the property, plant, equipment department. Nice and easy, a simple add right here. Equals. Remember the patents. If you don't, I brought the slide forward. Go take a second look at the slide. Right? They were for 40. And then here's the amortization. We just credit the account directly. There's no accumulated account. Then we total everything up right here. Liabilities added together. This was a nice and easy one. Nothing going on with liabilities. Capital stock. Remember, Sun stock goes away. Remember, Sun's retained earnings go away. Now let's look at that non-controlling interest share. Remember your journal entries that you made earlier. If you don't, I remembered them for you over here in the corner. Here is your non-controlling interest of 44 credited. This is where you'll credit. And then your non-controlling interest for the end of the year, right here. And again, if you don't remember, I do. Those credits are just coming together and being added right here in the final column. It's not as hard as it looks. You just have to suss through it and take your time when you're working these things. Alrighty, let's keep rolling. Okay, so let's take a look at this income statement. So the first thing we're going to do for the income statement, for a combined income statement, remember we've been doing combined balance sheets. First off, you can breathe a super big sigh of relief because the hard part is now over. So now all you're going to do is add Pop and Sun's revenues together, again, clearing out the income from Sun. The expenses, we're adding them together. What is this for from? The debit. Of course, this debit is going to be an increase in expenses. That is that patent. Remember that patent amortization from way back when? There it is, coming back. And maybe it might even make you feel better if you put a parentheses around it. But because it's a debit, we just leave it placed. But if you're concerned, put a parentheses. Don't get mixed up, right? Expenses are debits. And the reason why it shows as a negative is that because this is the balance sheet, and then we're adding to the balance sheet. Expenses showing as a debit. So that's why it's not 476, it's 484. The debit means a decrease, okay? So that's how we get 484. All right, the next thing is the non-controlling interest sheet. Remember when I said there's one sheet that's more important, one slide that you really need to pay attention to because we do so much work that comes up later? That's it. So our non-controlling interest share of the adjusted income is this 9.2. Right up here, you barely see it. I tried to fit as much on this page as I could and still get my little face down here in the bottom right corner. And then the last little bit is just a simple adding together. Big kicker, the net income from Sun, out. Out. Okay? Hopefully that's helpful to you. Okay, so now we're looking at, we're almost to the finish line here. We've got the retained earnings account. So let's look at the statement of retained earnings from 2016. First thing we want to go with is beginning retained earnings from POP. So that would be from POP's balance sheet. Not really something we got to go figure or anything. That's good to go. And then we're adding Sun's retained earnings. If you go back to, it might feel like a long time since the problem was given to us. If you go back to the first page of the problem, they've got it listed here, retained earnings is 60. Super simple. The big kicker is we're washing it out. We're only going to show POP's retained earnings in the consolidation. Okay, so beginning retained earnings of Sun is, as we said in the little checklist over here, is eliminated. Okay, Sun's dividends. Let's go in here and look at that. You can see right here we have the breakdown, Sun's dividends, parent non-controlling interest breakdown right here, but wash. We're not going to put any of that in the consolidation column. Do you remember, I actually skipped this by accident, I didn't mean to. Do you remember the net income from the slide before? That's going to become POP's net income. Sun's net income, out. All right, so the retained earnings is a great, easy sheet for you to work. It's pretty much kind of like a capstone of everything that's happened. Okay, so now at this point we're starting to feel like old hat. Like we should have a good handle on this. So now what we're going to do is we're going to go in and again we're going to take a look at the assets next. Okay, note now that the investment in Sun has been eliminated. That means that all of the investment has been kind of consolidated or spread out in the consolidation of POP and Sun's main financial statements together, with POP being the consolidator, the big owner of both of the companies, or the majority owner. So what we're going to do here is add the cash together for POP and Sun. Same thing with other current assets. Nice and easy. Remember when we calculated this on the previous page? Same situation, right? We show this broke down, but guess what? On the consolidation, it doesn't go in. We don't put the investment in Sun on the consolidation line. Property and plant and equipment. And again, the reason for this is because it's already been circulated throughout the balance sheet in other areas, or put into the other accounts. All right, and then the differences have been reconciled. Here we're going to add the patent that we picked up and also credit it for the expense, or the amortization expense. So this one's a pretty easy one. Okay, so now let's go ahead and take a look at the liabilities and equity. So the first thing we're going to do is the easy stuff. So the first thing is add POP and Sun together, and then here's our consolidation for liabilities. Nice and easy. So far, so good. Capital stock, get rid of that. We're not adding Sun's capital stock in. Why? Because this is POP's consolidation financial statement, and Sun is a subsidiary. We're going to clear off their capital stock. Means nothing to POP. Otherwise, they probably would have bought someone else. Okay, all joking aside, let's look at the retained earnings. Okay, POP's retained earnings and then Sun's retained earnings. All right, well, get rid of Sun, same thing there. And again, that was back from the problem way back at the beginning. If you're confused, go back and look at that very first slide. And then I pulled in the reciprocal non-controlling interest credit. Here it comes back on the paper. Right here for January 1. That was our very first credit. And then the last little bit when they paid the dividends, right, the non-controlling interest share, all right, that's going to come in right here as of December 31st. These added together will go on the consolidation sheet, and then all of this will get added together. So again, Sun's capital stock eliminated. Retained earnings are not calculated against the row. Non-controlling interest at year end is proportional to Pop's investment in Sun's account. All right, and it shows you the little calculation. I tried to keep it really nice and tight and scoosh it all in at the bottom. All right, good news. We're through 2016. Is anyone excited about doing 2017? All right, let's take a look. All right, so I'm probably not going to pull in the slides as much this time just to keep this rolling, but I'm going to go through this one a little bit quicker for 2017. If you're confused, pull in the slides and go back and take a look. So the first thing is that patent amortization. So we remember that, the amortization for 4. We're going to take the unamortized balance again, and take off the amortization 2017. I believe that this is an error. I think somebody put a 2 in here by accident. It should be 4. Is you would take the 36 minus the 4 and get 32. Okay, so you'll use this worksheet for the amortization expense. You remember the patents, right? Okay, so now again, 2017, again, this is the most important slide that you will see and work on. So let's just look really quickly at 2017 just for review of the breakdown from the controlling interest and the non-controlling interest. First off, Pop owns 80%, so we're going to take this 56 here just to show you again, and I'm going to just put my phone up so you can see. 56, it's the opposite when you're doing it, by the way. If you ever have to do a recording, it feels very backwards. 80%, 44.8, okay? That's where that's coming. So I'm just multiplying it times 80. And what I'm doing is I'm peeling off the non-controlling interest part. I don't want to put that into my consolidated income statement because I don't own that portion of the subsidiary. Okay, so now what I've got here is my adjusted income. I'm showing the differences between my share and the non-controlling interest share. All right, let's take a look at the rest of it. Okay, the dividends here. I just want to do one more thing here also, just to show me where my yellow goes, right? Let's do the dividends next. Once you do it once or twice, it just becomes old hat. So this 2017 will probably go a lot faster. Breaking down between the 80%, 30 times 0.8, 24, 30 times 0.26. Now what I have is a very nice setup for 2017. We've already done 2016, no worries there, but now I've got 2017 set up and ready to go. And again, once you do this once, the second time around, it just starts feeling very natural. So we're going to take our income right here that we just figured, subtract our dividends. Again, we're only working on the 80% right now, right? Using the steps. And then right here is a plug. What are we going to do with this plug? Later on, you know the end of the story, right? We're going to take this investment, put it on our consolidated balance sheet. But for now, we're just going to call this the plug. Okay, so we're going to go ahead and take a look at recording the non-controlling interest in the subsidiary from POP for Sun, earnings and dividends. So again, and this is the same as what we did in 2016, only now we're doing 2017. So the adjusted income is going to become get adjusted off for the non-controlling interest share of the income, and then we're going to credit the dividends for the subsidiary for Sun. Right here, you can see for both of the non-controlling interest shares. So basically, what we're doing is just peeling off that share of the income, and then again, this is going to be the plug right here. So here and here, and then our plug. And we've done this before, so it might start to feel a little bit like old hat. And then we're going to eliminate the reciprocal balances. I know you can't see this area. This is 188. I'll see if I can even, I can't put this over. This is from that balance sheet from the, if you walk back a couple of slides, that's from the balance sheet. And then right here, I want to point out the adjustment down in patents. Remember, patents started out at 40, now it's down to 36 because of this amortization. Okay, and then of course the capital stock and retained earnings eliminated, which we're very familiar with. Okay, so the first thing we're going to do here now is we do the entry 5. We're going to eliminate the investment Sun and establish the non-controlling interest for 2017 as of the beginning of the year. So to do this, we're going to come in here and we're going to work on the implied value again. Okay, this is the tricky spot right here where we add the increase in retained earnings from acquisition to the beginning of the current year. So if we had 80 at 2017 beginning, we have to take off that part from the beginning of 2016. So there's been an increase in retained earnings this year. And then take off the patent, and that gives us an adjusted value. And then, as you remember, our investment in Sun, and this is also on previous pages, and our non-controlling interest amount, these are all check figures you could use to make sure that you've got everything right. You can do all these verifications. Now that you have this figure, if you remember, our non-controlling interest was a plug. Now you've got something to check figure it against. Okay, so in 2017, same as 2016, you're going to go ahead and amortize the patent just as you have before. And this is just the journal entry for it. And then you're going to eliminate a reciprocal note payable where Pop and Sun have a note between the two of us. So, and again, I like to make that joke about the joint checking account. There's no reason to show these two on the balance sheet if they're between the sub and the controlling interest. Okay, so and oops. Okay, so let's take a look at the balance sheet. Same. I've done this a few times now. I'm really hoping this is starting to become old hat. So cash is added together. Note receivable, remember that was a reciprocal balance, so that's just going to wash out, credit out right here. Other current assets added together. Investment in Sun, right? This is the breakdown between controlling and non-controlling interest, but it does not go in the consolidation corner. Property, plant, and equipment, right here. Patents, subtracting out the amortization here. All right, and then note payable right here, reciprocal. So this is just going to wash. Liabilities added together. Capital stock, we're most concerned now. in an emergency situation, you're like, maybe this will wash out. It will not. We take this off, but we still have to show the capital stock from top. Retained earnings, this is a wash, and then the non-controlling interest, right? Okay, so let's say we run into some problems. We run into some errors on the consolidated balance sheet. We're not getting it to balance. So here's some of the issues. We check for emissions, the non-controlling interest share, its income, goodwill, the equity for non-controlling interest. Make sure that all debits and credits line up. Verify your totals and recalculate the consolidated amounts, making sure that you don't list anything that in the consolidated line that's not supposed to be there. Okay, so I'm going to buzz through the last consolidation techniques and procedures as we start rounding it out. One more last. Okay, so this is my last example. Pam had paid $360 for 90% of Sun when Sun's equity consisted of $200 capital stock and $50 in retained earnings. Inventory was undervalued by $10, $30, and $80. I actually listed that underneath here just so you could have like a running score sheet. Equipment was overvalued by $20. Sun's income and dividends were $60 and $20. So that means here I'm just going to point to this. I think a lot of times when you're doing these problems, it helps to kind of rewrite it. Make sure you line everything up. 60 and 20 for the dividends. Make sure you, I can't fix this here. I can't stand it to be like that. It looks terrible. Okay, here we go. And 20. That way you know what you're doing. If you try to do it in your head, it's going to be a mistake. Okay? Dividends payable at 10 has not been recorded. Cash in transit. Okay, so there's a lot going on here. Okay, so let's just take a look with the unamortized balance. Remember, inventory will be amortized in full first year. Land is non-amortized, so there's no amortization. Building divided by 20 years, right? You got that right here. Equipment was undervalued. All right, it's a 10-year amortization, so it'll be a total of 2. And then the goodwill is not messed with. And so that is your difference between your amortized and your unamortized balance. Up over here in the left-hand corner, you've got the cost of Sun. You divide by 90 to get the implied fair value. Your book value, oops, this is kind of hanging. Hold on. Kind of stuck. Sorry. Your book value is your capital stock plus your retained earnings added together from the problem. And here's your excess. Here's your non-controlling interest share from the implied fair value, 40. So now you've got a nice little run through on that. Okay, so let's take a look at the breakdown from the non-controlling interest and the controlling interest. So we take the adjusted income. We're going to peel off the part that doesn't belong to Pam, right, which is the non-controlling interest share from the 48. So her 90% share is 43.2. We're going to take off in the dividends that belong, again 90%, and then peel off the the non-controlling interest share of 2. Okay, so we're going to do some adjustment. We haven't had a chance to do adjustment for errors, no omissions. We had a dividends receivable that hadn't been put in, so we get that in there right there. We're going to fix the cash account. All right, there's no intercompany profits or losses. Yay. I wasn't sure if this dividend was an intercompany, but it looks like it was just an error omission, so that's good news. And then we're going to break down the income from Sun Remember, this was the 90% share from the previous page and the 90% of dividends. And then this is going to be a plug. Okay, so let's look at the non-controlling interest shares. We're going to go ahead and make that recording right here. And that's going to be their non-controlling interest share. And then we're going to credit the dividends between the income, the share of the income, and the dividends. You're going to credit non-controlling interest. So there's another plug. Okay. Here's our capital stock of retained earnings that's coming out. Remember our unamortized excess calculated from the other page. All right. And then we're going to credit our investment and the non-controlling interest portion. Okay, so I don't know if you're able to remember from earlier slides where we had those over and under values. So those will come into play right here. Remember, we had to add more to land, building, record goodwill. Equipment was overvalued, so we have to do that. Then we have this unamortized excess from our earlier calculations right here. And then what we have here is a plug. Nice little plug, cost of goods sold. Okay. Okay, so we are going to go ahead and fix the differentials between fair value and book value. Trying to find my little marker. Here we go. So we take the depreciation for buildings that we figured earlier, the depreciation for equipment, and the reciprocal balances and dividends payable. And then here's our final worksheet. Again, everything adjusted. All right, last but not least, we're going to look at the consolidated statement of cash flows. And you'll note that I didn't go too hard on your 2000 worksheet example, just because I think we've got it now. After an hour, I hope we do. So, but I want us to look, I didn't go through that too much with you. One of the things is I was running out of room in my video, but you're welcome to also download these and go back through your worksheet, play around with a little bit from that last example. So, all right, so the last little bit is consolidated cash flows. Is very similar. And we're going to, operating, investing, financing, we remember those. Cash acquisition and disposition of the subsidiaries and the equity investees. So that would be for the consolidation. We have direct and indirect method. So the direct method, we include cash dividends received from the equity investees, but not the equity method income. And then the indirect method, we start with the controlling share of the net income, add the controlling interest share, and then deduct the excess of the equity method over the cash dividends received from equity investees. All right, so I'm not going to hit this appendix just because we are a shorter term class. Instead, I'm going to thank you for your time today watching this video, encourage you to practice the consolidation worksheet. I think you guys are going to do a great job on that. And have a great week. Watch for Chapter 4 or Chapter 5 is coming out shortly. And thank you.